You know, there's a secret language that dictates pretty much everything, from your mortgage rate all the way to the health of the entire economy. It's not spoken, but it is absolutely understood by every major player in finance. And today, we're going to teach you that language, the language of bond yields.
So let's start with a quick question. Imagine you're an investor, okay? You've got two options sitting in front of you, a bond for $95 and another one for $105. So which one is the better deal? Your gut instinct probably tells you to grab the cheaper one, right? The $95 bond. But what if I told you that in the world of bonds, that's not really the right question to be asking? Because a professional bond trader, they wouldn't even really look at the price first. They'd look at you and ask something totally different. They'd say, what's the yield? That one little word, yield, is the absolute key to understanding this entire world. And this right here is the main idea we're going to unpack today. You can think of it like an iceberg. The price tag is just the tiny tip that you see sticking out of the water. But the yield, well, the yield is that massive, powerful part hidden underneath. It's what really tells you the true value of your investment. So to really get a grip on yield, we first have to understand the basic anatomy of a bond. Think of this part as, learning the essential vocabulary before we can have a full-on conversation. Let's break it all down. First up, we have what's called the face value, or sometimes the par value. The easiest way to think about this is like the price printed on a concert ticket. It's the official value, the amount the issuer, say the government or a big company, promises to pay you back when the bond's term is over. It's a solid, fixed number, usually something nice and round like $1,000.
Yeah, a really good way to think about it is just as a simple promise. The issuer is basically saying, look, no matter what happens out there in the market, no matter how messy things get, when this thing matures, I promise to give you this exact amount back. It's a guarantee. Okay, next up is the coupon rate. Now, this is your reward for loaning out your money. It's a fixed interest payment that you get every single year. So if a $1,000 bond has a 5% coupon rate, that means you get a check for $50 in your pocket year in and year out. And the most important thing to remember here is that this rate is locked in. It's set in stone. It does not change. It's kind of like having a fixed salary, you know? You know exactly what you're getting paid. The bond issuer doesn't really care if inflation skyrockets or plummets. They've promised you that fixed coupon, and that's exactly what you're going to get. And finally, every bond has a maturity date. This is the finish line. It's a specific date when the loan is officially over and the issuer pays you back that original face value in full. Now, this could be really short, like just a year, or it could be decades away, like with a 30-year bond. To put it really simply, maturity is just when your financial relationship with that bond issuer officially comes to an end. The handshake's done, the deal is complete, and you get your original money back. Simple as that. Okay, so vocabulary lesson is over. Now we get to the really juicy part. Seriously, if you remember only one thing from this entire explainer, please make it this. This is the golden rule of the entire bond market. It's all about an inverse relationship, just like a seesaw. When a bond's price goes up, its yield goes down, and when its price goes down, its yield goes up. They always move in opposite directions. So let's see exactly how this works with some actual numbers. Let's imagine we have a bond with a $1,000 face value, and it pays out a $50 coupon every year. Now, if you buy this bond for exactly its face value, $1,000, your yield is super simple to calculate. $50 divided by the 1,000 you paid, that's 5%. Nice and straightforward. But here's the thing. Bonds are traded on the open market, so their prices are always changing. So what happens if the market price of that same bond rises to $1,100? Well, the coupon payment is still fixed at $50, but now you're getting that same $50 on a more expensive $1,100 investment. So your effective return, your yield, drops to about 4.5%. The price went up and the yield went down. All right, now let's flip it and look at the other side of the seesaw. What if that bond's price falls to $900? You're still getting that guaranteed $50 coupon, but now you're getting it on a much cheaper $900 investment. So your yield now jumps up to about 5.6%. The price went down and the yield went up. And there you have it, the golden rule in action. See how that works? That $50 coupon payment itself never changed. Not once. It's a constant. What changed was the price you paid to get that $50 payment. And that, right there, is what determines your real return, your yield. So the next logical question is, why? Why do bond prices have to move around like this in the first place? Well, it all boils down to competition and what else is happening out there in the market.
Okay, let's play this out. Let's say you're holding a bond that pays you a nice, steady 5% coupon. Life is pretty good, but then the market changes. The central bank starts issuing brand new bonds that pay 7%. All of a sudden, your 5% bond looks, well, kind of boring. If you wanted to sell it, who would buy it? Absolutely no one. To compete, you've only got one option. You have to drop the price. By selling your bond at a discount, the new owner still gets that same $50 coupon, but for a lower entry price, which pushes their yield up, making your old bond competitive again. That seesaws just keeps everything in balance.
Now, I know you might be thinking, okay, this is all just for traders and big shot investors on Wall Street. But the truth is, bond yields have a massive, massive impact on your daily life, whether you actively invest or not. Seriously, the ripples from the bond market spread out and touch almost every single corner of your financial life. The yield on government bonds, it's like a gravitational force, influencing the interest rate on your mortgage, your car loan, even the loans that businesses need to grow and hire people. It's truly a foundational number for the whole economy.
And that's because the yield on a government bond, especially from a stable country, is known as the risk-free rate. It's considered pretty much the safest investment you can possibly make, and it sets the baseline return that nearly every other investment, from corporate bonds all the way to stocks, gets measured against.
Think about it like this. A government bond is basically a loan to a government that can literally print its own money to pay you back. I mean, it's about as close to a guaranteed return as you can possibly get. A stock, on the other hand, is a tiny piece of a company, and its value can swing wildly or even go to zero. So if you can get a guaranteed 5% from a super safe government bond, you're obviously going to demand a much higher potential return to take on all the risk of owning a stock. So let's just lock in the three big takeaways here. First, a bond is really just a simple loan with three parts: a face value, a fixed coupon, and a maturity date. Second, the golden rule: price goes up, yield goes down. They are a permanent seesaw. And third, that government bond yield acts as the financial world's anchor. It's the risk-free rate that everything else gets measured against.
And that brings us full circle, right back to where we started. The next time you see two bonds and you're wondering which one is the better deal, you'll know what the professionals know. The real answer? It's not in the price tag you see. It's in the yield you get.